I'd like to thank everyone for joining me today. My name is Kishana Myrie-Smith, and I'm the founder and CEO of Tax and Business Advisors. We provide accounting and tax solutions for nonprofits, which allow them to focus on their mission while we help them thrive through financial support, accounting, and all of that good stuff. Like I mentioned, today I'll be covering how to build a financially healthy nonprofit, along with some of the strategies to stay financially healthy. So why does financial health matter for a nonprofit? Financial health is essential for a nonprofit's sustainability. Financial health is really the foundation of any nonprofit's success and sustainability. And without a strong financial structure, even the most impactful mission-driven nonprofit can be at risk. Now, there are differences between financial stability and long-term sustainability. It's really important to understand the difference between the two, which is basically financial stability is making sure that you have enough funds or cash flow to cover your current needs, versus long-term sustainability focuses on ensuring your organization can thrive for years to come. So it's more of a long-term view of your organization more strategically. And so a few things you may want to ask yourself as a nonprofit leader, a few self-checks is, does your nonprofit have enough cash reserves to sustain itself if there is a cash flow struggle? Do you track your financial performance on a regular basis? Do you have multiple sources of funds or income or revenue generation? And if not, this session will certainly help identify ways that your organization can strengthen itself and make it more healthy from a financial perspective. So what are the key components of financial health? There are essentially four major pillars of financial stability for an organization. The first one being the need to have clear financial policies and internal controls. It's really important that that is established for your organization. This will help prevent fraud, it'll improve your efficiency, and also ensure that you have compliance with various sources of funds, including, your grant funds that you're getting in, any sort of grant requirements. Usually you need to have policies and internal controls in place to appropriately handle those funds. The next pillar is diversified revenue streams. Relying on a single funder can be very risky for any organization. So that's why multiple sources of revenue just helps protect, the nonprofit from any sort of financial downturns. If they lose a funder, hopefully it doesn't prevent the organization from being able to provide its mission. While it might be a setback, it won't make or break the organization. So that's why diversified revenue streams is really important. Next, it's strategic budgeting and cash flow management. You really want to focus on having a well-planned budget in place. And what this will do is it will help you monitor your cash flow to make sure that you have enough cash flow to sustain you from, your operating expenses to as well as your program expenses. So it's really important to make sure that you have a robust budgeting process in place to help with your cash flow. And lastly, strong financial reporting and accountability. It's really important to have those things in place. What that does is it builds transparency and trust with funders and ensures that you have the right information that you need to make informed decisions. So again, that's another really important pillar to have for your financial stability for your organization. So understanding cash flow management. Next, I'll talk about why cash flows matter more than your budget balance might matter, right? So a lot of times people, want to measure their budget to actual, but indeed cash flow is really critical for any organization. So, a balanced budget, does mean that you will hopefully have some sort of financial security in terms of looking at things from a longer ranged view. However, cash flow is what keeps your organization running from day to day. That's a really important distinction between the two. And why even profitable nonprofits run out of cash? It's very simple that basically if you run out of cash and if your income is delayed, it can impact your expenses and your ability to cover your expenses. So even nonprofits that have positive financial statements or financial statements that look profitable can run into cash flow problems, right? And that can delay the things that you need to do as an organization. And there are a few best practices for managing your cash flow as an organization. The first being you want to make sure that you're forecasting your cash flow monthly. So that way you're able to anticipate any sort of shortfalls that may be coming down the pipe. Another best practice is maintaining a 3 to 6 month reserve fund to help handle any sort of unexpected expenses that may come to your organization. And lastly, you want to make sure that you are prioritizing your unrestricted funds to make sure that they're covering your operations rather than only your program-specific expenses. So again, it's about looking at your cash flow, understanding what's restricted versus what's unrestricted, and ensuring that that is sufficient to help you with some of your program-specific expenses for your organization. Or I should say the other way around, to make sure that that's sufficient to cover some of your general operating expenses as opposed to your program-specific expenses. So again, it gets back to looking at your unrestricted funds and making sure that you can continue to operate your organization. Revenue diversification strategies. We talked about why multiple streams of income is important and why it matters. Again, it's all about if you rely on one revenue stream, that opens your organization to risk. So it's really best to diversify. And I'm sure many of you are aware of what the major revenue streams are, but they're here. We have grants, which are good for both projects as well as your program support, that they can often cover, the things that your organization has to do, but often or sometimes grants come with restrictions and they require compliance. So they can be a little bit limiting in terms of what you can use them for. Next, there's donations and fundraising. And this is all about engaging donors, hopefully maybe on a recurring basis, just to ensure that you have a steady stream of income coming into your organization. Next is earned income and what some call social enterprises. This is when a nonprofit looks to generate revenue through things such as memberships, fee for service, or even if there's certain products that are sold, those can contribute to earned income for your organization. And lastly, corporate sponsorships and partnerships. Quite often, organizations or corporate sponsors or businesses are willing to support nonprofits. And really, it's often based on, the need of the organization. Does it align with the vision of how the corporation sees themselves as a good steward in the community of giving back? And again, it's another really good source of revenue diversification for any nonprofit. Budgeting and sustainability. Moving beyond the budget is really important, and it's important to think of things from a long-term perspective. You don't want to just budget year to year, like we were talking about before. You want to make sure that when you're budgeting, you're planning for more of a long-term view or long-term sustainability for your organization. Factoring in inflation, staffing growth, and reserves are really important ways to avoid any sort of financial shortfalls. Again, it's about looking at the things that not only you have now or what is your need, right, down the road when you're budgeting, and putting those things or considering those things when you're doing your budget. The next is that budget should be driven by your mission and strategic plan, not just by available funding. So again, this kind of gets back to, focusing on the mission of your organization, the priorities that your organization is setting, and having that help drive the budget and what you're spending your funds on. And lastly, it's really a good idea to review your budget and adjust accordingly. So conducting a quarterly review of your budget and adjusting it as needed so that you make sure that you're staying on track is another really good, important thing to do from a budgeting standpoint. How to build trust with funders and donors. This is really a critical thing that is important for the reputation of your organization. You want to make sure that you are accurately and timely reporting on any sort of financials. And it's really critical for gaining your donor and your grantor support. So making sure that they are timely and accurate when you present your financial reporting is really important and key. And there are, some pretty standard reports that most nonprofits are familiar with. The first being the Statement of Financial Position, which on the profit side is often called the balance sheet. And that really shows, again, your assets and your liabilities. Your Statement of Activities, which is also known as the income statement on the for-profit side, that details your revenue or your gross cash receipts, as well as your expenses for your organization. And then there's a Statement of Cash Flow, which tracks how cash is moved in and out of your organization. Is one thing to keep in mind from a financial reporting standpoint is it's really a best practice to have your reports reviewed by leadership at least on a monthly basis. So thinking your board members and things of that nature, just ensuring that everyone has an understanding of what is happening, particularly on the Statement of Activities or the profit and loss, as well as cash flow. Having an understanding of what's happening with the organization is really important for all leaders within the nonprofit to understand and get to know. Tracking and reporting grant funds correctly. It's really important to make sure that you are managing those funds in the right way. Again, it gets back again to your organization's reputation. Particularly if you have grant funds, you want to show that you can manage the grant funds appropriately so that hopefully it will lead to future funds that you can obtain for your organization. So you want to make sure that you're keeping your grant funds separate in your accounting system to ensure compliance. So you don't want to, have everything combined so that you're not able to separate your grant funding from your other funds. So it's really important to consider that from an accounting system standpoint. You also want to track all of your expenses and expenditures and report deadlines to avoid any sort of financial penalties. Again, this gets back to responsibly tracking what you're spending or how you're spending the funds and reporting on that timely per, could be per your grant agreement and things of that nature, but just make sure that you're staying on top of what you need to stay on top of from a reporting standpoint. Which brings me to the next one is compliance and making sure that you understand your requirements. So for example, it's really important to understand if you are required to have a single audit, and a single audit is for organizations that receive federal funding in excess of $1 million or more in a year are required to have a single audit. The other common form for many nonprofits is the IRS Form 990, which is the tax form that is standard. And there are different versions of the 990 depending on the gross receipts and some other asset categories that determines which 990 that you need to complete. But it's important for your organization to understand what the requirement is for you. And then another thing to consider is you want to avoid mission drift. It's a really good idea to focus on applying to grants that align with your purpose. You want to be strategic in terms of what you're identifying with what you're applying for and the grants that you are hopefully being awarded. And again, it's really a good idea to just make sure it's aligned with your organization's purpose in terms of what the grant funds that you're receiving and applying for. So avoiding mission drift is always a good idea. Key metrics that nonprofits should track. This slide just talks about some good metrics that many nonprofits should consider tracking to just understand where they are from a financial standpoint. The first one being, and after this slide, I'll be going into each one of them in a little bit more detail, but just a little bit of an overview. The operating reserve ratio. This measures how long you can operate without new income, or how long can your nonprofit operate without, getting some sort of new income in the door, right? The next one is program efficiency ratio. This gets to what percentage of your funds go to your program expenses versus your overhead or your administrative type expenses, right? Or what percentage of funds go directly to your programs. That's what the program efficiency ratio measures. Next, the liquidity ratio. This talks about, do you have enough cash to cover your short-term liabilities or your short-term expenses is another way of looking at it. Do you have enough liquid cash or cash that's easily accessible to cover the things that you need to cover in the short term? And last, dependency on a single funder. This kind of gets back to the revenue diversification I talked about. Are you over-reliant on one funding source? Do you have hopefully a couple of different funding sources that will reduce the risk for your organization if you lose one of those sources? So those are the quite popular ratios that I'm going to be talking about today. So just to delve a little bit into the operating reserve ratio, the very first one, that one, just from a formula perspective, is your operating reserves divided by your annual expenses. And like I mentioned before, this is measuring how long your nonprofit can continue to operate if no new funding comes in. Now, from a benchmarking perspective, a healthy ratio is usually at about 0.25 is a healthy ratio, or 3 months of reserves. So this means that the nonprofit has 3 months worth of expenses in savings, which is a healthy buffer. So you have that easily available to you to spend on your operating expenses. A concerning ratio or a low ratio or an unhealthy ratio is if you have something like 0.05 or less than 1 month of reserve. This means that the organization might struggle if funding is delayed. And just from a benchmarking perspective, an ideal benchmark is 3 to 6 months worth, which we talked about in a previous slide, which is usually a ratio of 0.25 to 0.5, basically. And again, that's looking at having, that standard 3 to 6 months of reserves to help you carry through any sort of funding delays or challenges that your organization may face. The next ratio is the program efficiency ratio. And from a formula perspective, that is your program expenses divided by your total expenses. As I mentioned before, this is measuring how efficiently your nonprofit spends money on its mission versus administrative and fundraising costs. So again, this is looking at how much do you have to spend on your programs specifically. So a sustainable or a healthy ratio is in about the 80% range. And that means that 80% of your funds go directly to programs, which quite often is more appealing to donors and grantors than if you were having less of your funds going towards your programs. So for the program efficiency ratio, a concerning ratio or unhealthy ratio would be at about 50%. So that would mean only 50% of your funds are spent on programs, and donors may question how efficient your nonprofit operates if you have a lower ratio for the program efficiency ratio. And in terms of a benchmarking perspective, an ideal ratio would be anywhere between 75 and 85% or higher for an organization to have for this ratio. The next ratio is a liquidity ratio. This is looking at your current assets divided by your current liabilities. And what this is measuring is whether your nonprofit has enough short-term cash, enough short-term assets, such as cash or receivables, to cover the short-term liabilities and or expenses, which are often things like bills and payroll. So it's kind of just really getting at how, liquid is your organization to cover its more immediate type expenses. Now, a healthy or sustainable ratio is usually at about 2.0. And what this means is that your nonprofit has twice the amount of assets needed to cover the short-term liabilities. Now, a concerning or unhealthy ratio is about 0.8. And what this means is that your nonprofit doesn't have enough cash and might struggle to pay bills in the short term, if you have such a low ratio. And from a benchmarking perspective, an ideal ratio is 1.5 to 2.5% for any organization on the liquidity ratio. And lastly, the last metric is the dependency on a single funder. This is looking at your largest funding source divided by your total revenues. And what this is measuring, once again, is how reliant your nonprofit is on one funder, which again could lead to risk if that funding source is lost. So a healthy ratio for this one is 0.25 or 25%. And that really means that your largest funder provides only 25% of the revenue, meaning that your nonprofit has diversification in terms of income sources for the organization. Now, a concerning or an unhealthy ratio might be about 75%. And what that would mean is that 75% of the funding comes from one grant funder or donor. And that leaves the nonprofit vulnerable to financial instability if they lose that funder. Now, from a benchmarking or an ideal perspective, as long as no single funder is contributing more than 30 to 40% of the revenue, that is usually a good benchmark to have for your nonprofit for the dependency on a single funder ratio. Okay. So next we'll talk about some practical steps to strengthen financial health of your organization. The first being implementing financial policies and procedures. I think this is one of the first pillars I talked about. It's really important to have financial policies and internal controls to not only safeguard your assets, but, show financial responsibility, prevent your organization potentially from any sort of fraud, waste, or abuse. So again, that's kind of like the foundation of a strong financial practice, is to make sure that you have sound financial policies and procedures and internal controls in place. The next one is using an accounting software that is tailored for nonprofits. So there are several software. There's QuickBooks for nonprofits. There's Xero, there's Sage. There are different software that's out there that exist. But one key thing to keep in mind is that you want to make sure that it's tailored to nonprofits, and that also the reporting is hopefully tailored to the needs of your organization as well. So many of these accounting software, have the ability to tailor the reporting as needed for the organization. So for example, if you need certain grant reporting within QuickBooks, there's a way to set it up so that you can run reports on a specific grant to see how the grant is performing and things of that nature. So the key being having a good accounting software and making sure that your reporting is set up appropriately for you to have what you need from a reporting standpoint. And the next one is training staff and board members on financial literacy. It's really is a good idea to make sure that there is a good understanding at the board level of financial statements, understanding, budgeting, and just to have that level of awareness for board members and staff as well, depending on how they participate within your organization. And what that does is that not only gives them the additional information about the organization, but it also helps to enhance the decision-making process. So again, if members, staff as well as board members have financial literacy, it only benefits the organization. And it's a good idea that even if board members don't have that level of expertise, having a few trainings, perhaps inviting an accountant or a CPA to do a training for the board members if the level is not there, is really a good idea to help your organization from a leadership standpoint. And lastly, conducting an annual financial health checkup. This is sort of like an internal review of sorts. It's not an audit, but this might be something that an organization might do themselves, or they may hire someone or accountant or CPA to do it for them as well. What that is doing is that it's looking at a few things. It's looking at, the reserves, the reserves in terms of cash reserves that we talked about, right? It's looking at their revenue diversity, right? We talked about the importance of revenue and diverse revenue streams. It's looking maybe at their financial performance, maybe looking at some of the other metrics that we just talked about. But again, it's about looking at the organization, excuse me, annually, and just giving it yourself a checkup to see how you are doing from a financial health standpoint. Okay. So I would like to wrap this up with just a few final thoughts. One thing to keep in mind is that financial health isn't just about keeping the doors open. It's also about ensuring that your nonprofit thrives long into the future. So it's, handling things financially today, but also looking out from a long-term strategic perspective to help your organization thrive. And it's really important for financial health to be a part of that journey for your organization. By implementing these strategic type strategies, not only do you strengthen your financial foundation, it also helps build trust with funders as well as donors. And ultimately, it can help just create a bigger impact in your community. If you have these sound things in place, hopefully you can continue to do the good work and the mission work that your organization is doing, and just continuing to thrive while still maintaining your health financially for your organization.